We are going to start this section with gross profit and gross margin calculation. Gross profit is the profit retained from the sale value of the product after deducting the cost of obtaining this product. The formula for gross profit is gross profit equals sales price or sales value minus cost price or cost value. Cost price or cost value is also referred to as COGS, which stands for cost of goods sold. Gross margin is the percentage of gross profit out of the sales value. The formula for gross margin is sale price minus cost price, then divided by the sale price and multiplied by 100 to get the percentage. Example: if you buy a product at $4 and sell it at $10, the gross profit is going to be $6 and gross margin is going to be 60%. When you want to calculate the gross profit and gross margin for the entire business for a certain period of time, you apply the same formula, but on the entire sales value instead of the price of a single item. For example, let's say store A generated $124,000 in sales for the month of June. The cost of goods sold, or COGS, for the products that have been sold throughout the month was $73,456. Let's apply the formulas. Gross profit equals sales value minus COGS. That's $50,544. Now let's calculate the gross margin. Applying the same formula, sales value minus COGS divided by sales value times 100, gross margin equals 40.76%. The importance of gross profit is that this is the amount that is going to pay for all the business expenses. After you subtract the cost of obtaining the product and pay your suppliers, this gross profit is then used to pay for the operating expenses, marketing expenses, admin fees, interest, and taxes. So it is important to maintain a reasonable gross margin for the business to be profitable at the end. This is done through correct pricing in the first place and using markdowns very strategically so that they can help in driving sales and clearing unwanted merchandise, but also don't erode much of the gross profit so the business can still remain profitable. Which takes us to the concept of markdowns in the next lesson. Markdowns are reductions on the sale price of the product with the intent of accelerating and stimulating sales. Markdowns are expressed as a percentage discount on the original price and calculated in the following way. Markdown percentage equals original price minus sale price divided by original price and then multiplied by 100 to get the percentage. For example, let's say a product is priced originally to sell at $12. Then a markdown has been applied on it during sale time and it is now selling at $6. Applying the formula, we get markdown equals original price minus sale price divided by original price times 100. So this product has been marked down or discounted at 50%. As we mentioned before, markdowns are a very useful tool for retailers to drive sales and also to accelerate the clearance of unwanted merchandise. However, because markdowns affect the sale price of the product and it directly affects the gross profit of the business, it is important that they are planned carefully and used strategically. Usually, a retailer applies a gradual markdown process where the markdown percentage or discount level increases with every markdown event. For example, a business could start clearing merchandise at 25% and then after a while raises that discount to 50%. And then in the final clearance phase raises the discount again to 75%. Because markdowns affect the gross margin of the business, the gross margin that is realized after all the discount is differentiated from the initial gross margin that the product has been priced at. And they are segregated into intake margin, and this is the margin the product has been priced at, and realized margin, and this is the margin after all the markdown has been applied. For example, let's say you bought 100 pieces of t-shirts at $3 each. You priced each t-shirt at $10. The gross margin you would get if you sell all the products at full price, that's $10, can be calculated as gross margin equals sale price minus cost divided by sale price times 100, that's 70%. This gross margin is called intake margin. However, in real life, you didn't sell the entire order 100 pieces at $10. You sold 20 pieces at $10, then you had a markdown event and applied a 20% discount and sold 30 pieces at $8. Then you had a mid-season sale and applied a 50% discount and were able to sell another 30 pieces at $5. Finally, in the end of season sale, you applied a 75% discount and sold the remaining 20 pieces at $2.5. Let's calculate the gross margin you actually get out of this order. In order to calculate the actual sales value, we will do the following calculation. We will multiply the number of pieces and the price they have been sold at. So sales value equals 20 times 10 plus 30 times 8 plus 30 times 5 plus 20 times 2.5. So that will give us a sales value of $640. So you were able to get a total of $640 of revenue out of this order. And we know from the order cost that you bought 100 pieces at $3 each, so your cost value or COGS was $300. Just a quick note regarding COGS. It includes the cost associated with obtaining the product until it reaches your warehouse and is ready to be displayed on the floor. This could include the shipping costs from supplier to your warehouse, custom fees, if any, and product handling fees such as labeling and tagging. What goes into COGS differs from one business to another, but this is just an example to explain that this is not only the manufacturer's cost price. So now to continue. Now we know that sales value is $640 and cost is $300. Let's apply the formula to get the margin. So the gross margin equals sales value minus COGS divided by sales value times 100. This gives us a 53% gross margin. So as you can see, this order had a 70% intake margin, but after applying all the markdowns, the realized margin is 53%. Here you can also see why it's useful to run all the retail math to get the real margins of the order. This will give you a more realistic view on how much the business actually gets out of a product, instead of assuming that the full price provides the real view on margins. This is useful while initially pricing the products by taking into consideration future markdown events and discount levels. And it's also important during the markdown planning phase and setting up of the events calendar for the year to make sure that the frequency and level of discount or markdowns applied throughout the year are in line with the budgeted gross margins in the P&L. Another concept that is used during pricing the product is markup. Markup is the percentage representing the amount added to the cost price to set the sale price of the product. The formula for markup is markup percentage equals sale price minus cost price divided by cost, and then multiplied by 100 to get the percentage. For example, if you bought a product at $2 and priced it at $4, the markup will be 4 minus 2 divided by 2 and then multiplied by 100, that's 100%. So this product has been marked up by 100%. It's important to differentiate between markup and margin. Markup is a percentage relative to the cost price, while margin is a percentage relative to the sale price. For example, here the amount added to the cost price is $2. When you add this $2 to the cost price of the product, which is also $2, you get a final price which is $4. Markup is the added $2 relative to the cost $2, so here it's 100%. Margin, on the other hand, is the added $2 relative to the sale price, which is $4, so margin here will be 50%. In fact, any product that has 100% markup will automatically have 50% margin. If a product has 200% markup, for example, it costs $2 and priced at $6, it will have a 66.67% margin, and so on. As we have said at the beginning of this section while explaining gross profit is the first profit amount out of the sales of the products. This amount is then reduced further by paying the different business expenses. After all the business expenses and taxes are deducted, the final profit amount is called net profit. This amount, when expressed as a percentage of revenue or sales, is called net profit margin. The formula for net profit margin is net profit margin equals net profit divided by revenue or sales and then multiplied by 100 to get the percentage. For example, if a business generated $1,257,469 in sales for the year 2021, after all the expenses and taxes have been paid, the net profit amount was $62,873.45. Applying the formula, the net profit margin is 5%. Another metric used to express financial profitability is EBITDA. It's used to give a better picture of the profitability of the company by eliminating capital expenditures and financing expenses. This is simply the net profit amount in dollars added to it the amount that has been deducted from taxes, interest, depreciation, and amortization. So the formula for EBITDA is net profit plus interest plus taxes plus depreciation plus amortization. For example, the same company that we have calculated net profit for, this company paid $3,984,000 in interest, $18,567 in taxes, and a total of $5,377 for depreciation and amortization. So EBITDA is going to be $90,801.45.